Hello everyone and welcome to our live stream. It's 11 a.m. on a Sunday and I'm so grateful for everybody who has joined us. We have a very interesting stream today. We did our investor webinar yesterday, right? And this is the same sort of a content. We're going to be talking about a lot of interesting things, right? From how the fund performance has been, how what we think about the market. And as you guys will see, the topic of the webinar is Vishalji is saying that my voice is little low. So let me speak louder. So the topic of the webinar is that why this market favors active over passive. I have Siddharth here also on the live stream. He will jump in, I think, when we go to the Q&A. But yes, I think a lot of interesting things to talk about, and what we want to talk about is that this market definitely is very interesting for us, right? I think people are worried where the Nifty is going. Is there consolidation happening, what's happening? But we think it's very interesting, specific for the type of strategies that we run, right? Which is active strategies, with a flavor of momentum. And I think it's a very good market for that, and this is what we'll be talking about in this webinar. But along with that, we also have to talk about um what's happening with the strategies as well, right? And a lot of interesting things to talk about even there. So let's get started. I have my screen here for you, where you will see that we think that this market favors active over passive. On the surface the market definitely looks calm, but if you go underneath, you see there's a lot of different things that seem to be happening. There is instability under the surface. There's a lot of worry that we know as an investor, but the markets, the index level seems stable. The VIX is so low; it is 1213, right? So what is it is little bit contradictory, right? Like you have the market being stable at one side, VIX very low at one side, but then we as investors know that we are worried, right? There is instability in the market. So we're going to unravel that, and we're going to talk about why we think this is a good time to do active investing, right? So, but before we go there, we'll start by talking about the fund performance. And as you'll see from my slide, the first slide itself says that what doesn't kill us, it makes us stronger. And I think that is a theme, right? That is what we sort of have encountered in the recent times, right? I think uh, July for us, if you look at the PMS performance for Wright research, was a little bit, we saw underperformance in July. So 2026, every month our strategy has beaten the benchmark. Every month, Right Factor Fund has beaten the benchmark, and it's been going excellent. But July ended up being a little bit worrisome, where things were not looking very good. I mean, I would say not looking good, but not looking very pretty, right? At the end of the month, the strategy was down some 4%, and the market was up 2%. That led to a lot of investors worrying, right? So even, see, I think that is one bias that we have, that all of us go and check our portfolios at the end of the month, right? That, oh, what happened with my strategy? It is the end of the month. Let's try to compare all my strategies. And our strategy was underperforming at that point in time, right? And that got a few investors worried. We got even a lot of queries from our investors, right? That what's happening with the strategy, why is this underperformance, you guys picked up in 1 year and then such a bad month, etc., etc., right? But then what happened was that we held on to our stocks with conviction. We knew that, okay, it's month end, things are not looking well, but we are not selling. We have conviction in what we are doing, and we expect a bounce back. And the bounce back came in 5 days. In 5 days of August, our strategy has grown above the July underperformance, right? So we've taken over whatever underperformance we had in a matter of 5 days. So right now YTD as of 7th of August, YTD performance is 10.12%, right, for the Wright Factor Fund, and BSE 500 is down minus 0.7%. All in all, we are up 10.8% in this calendar year 2026. Till the 7th of August, we are up 10.8% compared to the benchmarks, right? And while it is good for investors, it is good for the strategy, it also is an indication that this market favors strategy like ours, favors strategies that do dynamic allocation, that do active investing, that have a focus on momentum, that look at multiple factors, right? So this is what it proves. It obviously, what doesn't kill us makes us stronger, because this time our conviction sort of worked for us, and that is something that's very beautiful, right? Now what happened in July, right? I think July was bad, but what happened in July? So we'll just try to dig deeper into that. So July was a month where we all know that Kospi, the South Korea index, went through a correction. We've done videos on it, that as well, right? That theme. That obviously we were allocated to the data center theme, not very aggressively, but we had multiple allocation. We had allocation in MTR Tech, which is a primary supplier to Bloom Energy, which is the core company in the data center theme. Then we had Black Box. Then we had GVT&D, which is in the power sector, very exposed to the data center theme. We had AIA Engineering, Engineers India, these ancillary companies, which also have a lot of exposure to the data center theme, right? Apar Industries even. So all in all, we did end up having exposure to that theme. And when the Kospi corrected how much? Like 50%. That did have an impact of 4% correction in our strategy, right? It was not that big, but obviously that did have an impact. But we did not panic, right? This was thematic risk. This was not sectoral risk. This was not stock risk. It came from outside India. But see, I think if you look at all of these companies, the order books are very strong. The fundamentals are very strong. The projections are very strong. But we were seeing a short-term correction. This was led by the MTF liquidation, or what we saw with the situation awareness hedge fund correcting, right? So all of these factors led to a sharp correction. But we knew that this theme will recover because our model was telling us this, right? And then in a matter of a week, the recovery has happened. So MTR went down 38%, it recovered 23% of the lows, right? And same goes for a lot of different stocks. Now in terms of thematic pain, we had I'm sorry, I think I shouldn't be showing this on a public thing, but yeah, see, I think in terms of thematic pain, the thematic thing, what it would say is that that a lot of stocks where we had the industrial focus, they saw correction, right? The industrial focus saw correction. But on the other hand, we did have also allocation to the pharma theme, right? Pharma was pretty strong. So while on those days when you were seeing big correction in Kospi, our portfolio was stable because the pharma exposure and some of the consumer exposure were in fact supporting it, right? So the diversification also comes into play. And again, the recovery also happened pretty fast, right? The recovery happened in a matter of a week. You saw recovery in the stocks that I named, right, happened pretty fast, and then that was sort of also rewarded. And then the recovery, what it did was it sort of rewarded our conviction, right? So the big lesson is that first thing you have to do, I think we talk a lot about quant, right? And you will see a lot of new people are coming and doing quant, right? But at the end of the day, quant is just a model, right? And the investor behavior is the real enemy, right? You will get a panic. So imagine, the market is up, your strategy is down. Investors are calling, what's wrong with you? What are you doing that's not working? What's wrong with your strategy? Why don't you look at it, right? It's very easy to panic, right? Everybody would panic when you are at such high stakes, right? But the real quant comes when you have conviction in your models, right? And that is what we did. that we had conviction in what our models were telling us. And then what this proved was that conviction works, right? Conviction in our strategies work, right? The models, if you understand them, if you sort of focus on them, that would work. And that is what happened, right? So while you saw 3.7% correction in July, in the first week of August, we've seen almost 6% recovery, right? And that is what we think has been the most interesting lesson of the quarter. And I think this is a lesson that we have learned the hard way. I think we've talked to you on live stream on YouTube about 2025, right? 2025, when the correction happened, when Donald Trump came into power, we ended up, selling somewhere at the bottom, hedging at the bottom, which was, a calculated sort of a call, which, unfortunately didn't work due to the hedges expiring. But, had we held on to what were doing with conviction in a difficult time, things would have been better, right? So I think this is a lesson that we have learned over the last 16 months, and this is something that worked for us, so it makes us happy. But it's a dynamic market, right? So you have to keep your eye out, right? It's an instance, and we have to be very proactive with what we are doing right now. Now, before we go over what's happening in the market, where we think the allocation should be going, let's talk about the performance of the strategy, right? So this is 1 year performance of the strategy. Our factor fund is up 13%. Like I said, at the end of July, things were not very pretty, right? The outperformance had shrunk a little bit, but then you will see that right now we are at 13%. Market is at 4.7% for the year. So 1 year excess is around 8.3%. You go to 2026 only, which is YTD we are up 10%. BSE is slightly flat at minus 0.7%. And 7 out of 8 months, the strategy has beaten the benchmark, right? 7 out of 8 months, the strategy has beaten the benchmark, which tells you that something is going right within the strategy, right? This is since inception, so this is very interesting. We are talking on 9th of August, and I think so that 18th of August is when we complete 3 years, right? Correct? So that is on mute. So I think 18th of August, we're completing 3 years. You'll have 3 years performance of the strategy. And the 3 year performance of the strategy is roughly at 78%, right? Aggregate returns. And that amounts to 21% CAGR. BSE has done 12.8%. So we've beaten the BSE by around roughly 9%, right? And you can see that this spread between our strategy and BSE is getting wider, right? Which is pretty encouraging. Now let's talk about the market, right? Like see, we think it's a good time, right? We've gone down and come back up with conviction. So obviously we are a little bit pumped up. So we're talking a lot about our strategy, but let's talk about why we believe that active will work over passive in the current market, right? This is something that we sort of want to talk about, and this is the topic of the webinar, right? The first thing is, let's try to understand what's going on in the market, right? There are 4 things that I would like to bring your focus on, right? The first thing to look at is volatility. There is a lot of instability within the calm environment, right? So if you look at the VIX, the VIX looks very low. It is at 12-13%, but underneath you see there's a lot of instability that's going on. Second thing I would talk about is the dispersion, right? So this year the market has been flattish. 2026 we saw BSE 500 is minus 0.7%, right? But on the other hand, you'll see huge dispersion between sub indices, right? So if you looked at Nifty IT and if you looked at micro caps, right, you would see that there's a huge dispersion that seems to be going on, right? It's like one segment of the market is doing extremely well and another segment of the market seems to be struggling, right? So there's a lot of dispersion between the stocks. Third thing is that money is dear because rates are high, right? The rates are, the RBI has kept the rates high, that they have not cut the rates. I think the environment right now is higher for longer. Even the US markets, we're even hearing that rate could be hiked in the US market, right? And when you are in such a high rate environment, you tend to uh, the stronger stocks tend to outperform the weaker stocks. What I mean by stronger stocks is companies that have healthy fundamentals, that have cash in the balance sheet, that don't have a lot of leverage, right? They will differentiate themselves from the weaker stocks. And that means that there will be diversion, there will be dispersion between the stocks as well. And the fourth theme I want to talk about is flow, right? So I think FIIs are pulling in money, pulling out money, and SIPs are replacing the FIIs, right? Very, you'll see that happen. That every month FIIs are taking out money, whereas these guys, the SIP money is piling up, right? And that can have different implications that I'll go through in this webinar. So first thing we'll talk about is that the calm is a level but not a behavior. What that means is that the VIX level that you see is just a level, right? So let's look at India VIX right now. I'll just maybe quickly open this for you. Right, so we have India VIX here. You will see that, oh, the VIX is at a low, right? It is at such a low level. When the VIX is at 12%, it seems like a very low level, right? You don't worry much about it. It's like a very calm level 12, right? Only beyond 17, 18 is when people get a little bit worried, and when it goes very high at 25, 35, that's the real worry. So like, for example, during the whole March crisis, the high was at 27%, and then it has calmed down. Right now it is 12-13%, even though the escalation has been happening in the global market. But if you look underneath that, right, you'll see that the VIX level themselves have become so unstable, right? Like every day you see that there's a movement of 20% up, 30% down in the VIX, right? There is a lot of noise that's happening in the VIX, right? Every session, in fact, seems to have a very aggressive movement in the volatility index level, right? So which tells you that okay, it looks calm on the surface level, but there is a lot of instability that is happening within the system. Similarly, let's talk about the dispersion. It's the same market but with very different journeys, right? So like I was telling you that let's look at Nifty versus small caps versus IT, right? So this is over, let's go YTD, right? So let's look YTD. You'll see such a high level of dispersion. The small cap index is up, right? Nifty is flat, and your IT index has declined so much. It is recovering right now for sure, but you'll see so much diversion or dispersion in the same market itself, right? And that tells you that obviously you have to be selective. If you just invest in the Nifty 50, you'll get that average return, right? You'll get an average of what is happening, correct? But if you were selective, right, if you were able to first of all find the right set of stocks and sectors to invest into, and secondly you were able to avoid what has to be avoided, you would make better returns than what the average is giving. And that's why this is a market for active investing, or selectively finding the right set of themes and sectors to invest into. Then, as we said, high rates will help stock pickers, right? When the rates are high, one is that fundamentals become very dear, right? You will see that, okay, you might have invested in a company that's been growing very fast, but if the company has excessive leverage, if the company is not doing good fundamentally, then that could be a worry. So the quality spread tends to become a little bit more powerful in times of high rates. Secondly, what also becomes very powerful is that one, you have to choose where you're investing, but more important than that, you have to choose where you are not investing, right? This is very different from a passive fund, right? If there's a passive fund or a index linked fund, right? So a lot of active mutual funds, in fact, when you see, they have a mandate to just have some spread over the benchmark, right? They're not exactly following the benchmark, but they can't go very different from the benchmark also. So when that happens, right? So imagine there's a passive or a passive linked fund. What will happen with them is that they will end up owning IT, they will end up owning, all these different sectors, which might not be working, right? There's so much dispersion that certain sectors are not working. But those funds are constrained to invest into these different sectors as well, right? That is where, you know, you will see that an active investor who can take selective bets, right? A PMS or a small case, somebody who can take selective bets will tend to outperform the passive funds in these scenarios. Now, finally, let's talk about the SIP money, right? So, as of June, FIIs had taken away 78 lakh crores, no, 78,000 crores of money from the Indian market, right? But this is being supported by 30,000 crores of regular SIPs coming into the market itself, right? So FIIs are selling, but the domestics are supporting the market. This has a lot of different implication, right? One is that look at what happened in March, right? We saw like a 10 odd % correction when the war started with Iran. It's a major global event, right? It's a major global escalation, and India itself is not that, India's 40% crude oil supply got impacted. India itself is, we don't have AI or anything like that to support the market. So, it could have been a much deeper correction, but because of this SIP money, right, the market was cushioned and we did not see that deep of a correction, right? So that's a big positive. SIP money brings in liquidity into the market, that's supporting what's happening, right? So that's a big positive. But there's also a little bit of negative in this, and what is negative is that the SIP is going into these passive or passive linked funds, right? So, when a person does SIP, when this 30,000 crore flows in into the market, it is still going into the same, benchmarks, right? It will go into IT, it will go into, let's say, some of the PSU sectors which are not performing, right? Because it's just a passive basket. And, which is not bad, but what happens is that it sort of impacts the price discovery, right? So, the company is not doing well, fundamentally it's not doing well, but money is flowing, right? The fund manager has to invest because that is the mandate that they have. So it's an interesting time to look at this, and sometimes what would happen is, obviously it is cushioning the market, but selectively the impact on certain sectors can be delayed, right? That could also happen. Now, talking about themes, right? So we try to study themes more than sectors in at Wright Research, and what we are seeing right now is that the themes like one is pharma, where we've taken a lot of bets, so CDMOs, CRMs, similarly domestic formulations, right? That's a very strong theme. Our strategies have gone almost 15-20% in the pharma space. Secondly, I think finance and banking, so NBFC, asset managers, private banks, I think that's where we are seeing acceleration. Then I think the ancillaries and EV supply chain. Now the ancillaries, auto ancillaries, they are now also participating in the data center theme, and then the EV supply chain, that tends to be working quite well. Along with that, I think, small cap over large cap, I think that's one theme to bet on. And selectively, your oil refining, REITs, real estate investment trust, those are looking interesting. What we are avoiding right now, or what is not looking good right now, is something like railways and some sectors which are linked to policy, right? Like road construction, railways, recycling, gas distribution, some renewables and solar manufacturing, right? You're seeing some impact, or dairy, you're seeing some impact over there. I think there's some consolidation even in the travel and tires and all these spaces, right? Uh, so these are the things that you will not see in our portfolios right now, but there also are themes that are sort of maturing, right? So for example, data center power, data center infrastructure, I think that's where we have some allocation. Hospitals, we do have allocation in hospitals, microfinance, capital goods, transmission equipment, shipbuilding, capital market, PSU banks, right? There is, you've seen good growth in these strategies, in these themes, but it is sort of maturing, right? What that means is that this theme has reached a very decent growth level, but it might be slightly in the late stage. So you have to harvest some profits and you have to book some profit. You have to be careful about that allocation, and which is something that you have to do. We are aware that like we are not a data center fund, but we do have allocation there, so we have to be careful. But last month, the type of correction you saw, we thought that was a little bit blown off, so that's why we held, and we've seen this recovery, which has made up for a very good story, to be honest. Then if I look at factors, right, in terms of factors, I see that earning momentum is doing very strong. Price momentum has done very strong, but if you look at it, price momentum has weakened a little bit, and what you can see is earning quality and valuations are inching up, right? So you're seeing that tilt sort of come in, and right now, but if you look at top versus worst rated stocks, you will see that dispersion is strong with earning momentum, and I think our focus is slightly shifted towards earning and momentum and price momentum right now. Let's talk about the market sentiment. In terms of market sentiment, right, we are seeing uh, a little bit of greed. I think it is mostly neutral. This screenshot, I think, is a day old. Right now we are at mostly neutral territory, right? And we've come back from a sharp correction in May. I think we are in a decent sort of a territory in terms of the market, right? But if you look at the regime, right, our regime model seems to have shifted positive, right? So the model says that we are in a bullish market, and this happened somewhere around the end of July. Even if I look at liquidity, which is very strong due to the domestic flows, if I look at valuations are better than before. If I look at sentiment is decent, it's not bad. So that sort of looks, hints at it being like a bullish sort of a market. Bullish flip has happened in our strategies, right? And that's what our models are telling us, very honestly. But having talked about why we think active is important, because everything is not working. The market has become dynamic, right? I think we make a comment that previously 22, 23, if you guys were investing, you would see that, or 24, one theme would work for a long time. Like you saw PSU themes work for a long time, defense themes work for a long time. But right now in the current market since 25, what's happening is that these themes or these allocations are shifting every 3 months or 4 months. You're seeing that themes are shifting, right? One time 2025, at one period we were very defensive, right? Then we moved to industrials, right? We went aggressive at the end of last year, which worked well for us. Right now we're seeing some shift happen. Pharma seems to be getting allocation. There's some consumer allocation that's working for us. So I think the themes shift very fast, and that's what we believe, that that's why our strategy or active strategies which are able to pick up these themes would be important. But also let's talk about the counter view, right? That we are talking about active being very powerful right now, but what's the counter view? So many of you who look at the market, who read about the market, you would have heard that there is a study in the US market that only 10% of active funds beat the market, beat the passive fund, etc. Right? Those type of studies have happened. But if you come back and look at India, right, you will see that in the recent times, majority of active small and mid cap funds have beaten the market, right? Majority, I think the active outperformance has happened in India. That's why we all like small cases. That's why we all like PMSs, etc. Right? Because in India, that is not exactly the case, right? Because India is a very different market compared to the developed market. India is a market where there's a lot of themes emerging, where there's a lot of dynamism, and that is where an active strategy can do well. So active works, but it works selectively, and India is one of the markets where you'll see that this type of strategies work. Second thing, like I said, that more than sort of picking the styles, you also have to be aware of the rotation, right? If you don't know when the themes will rotate, right, I think that could have a detrimental impact. Right? For example, last year when we saw, okay, these defensives were doing well, we were allocated there, but had we not shifted to more industrial exposure, we would have underperformed for a while, right? So rotating is very important. And third is that the SIP money can sort of like I said, the SIP money is going into the passive funds. Passive funds invest into the average, right? So the market as an average is working, but that's not the case. Fundamentally, you are seeing that fundamentally IT is impacted due to AI. Fundamentally, there's a growth in a certain other sector, for example, auto ancillaries or data centers or pharmaceuticals, right? So there is fundamental difference. But if you have to, but because of the averaging out due to the SIP money, the effect can be delayed. So you have to be patient and you have to size properly to take advantage, and that is one thing that is very important. So the lesson here would be that you have to be selective. Like in the Wright factor fund, what we do is we take 20 to 30 stocks from a 700 stock universe, we rebalance it monthly. The dispersion that you see is monetized through the selection process. Second is that we rotate with the regime, right? We don't stick to one set of stocks. As the regime shifts, we adapt how we allocate. Now thirdly, I think we also have an option for investors that you can link your performance, link your fee to the outperformance, right? So if the fund is not performing, you don't pay us anything, so you can do that. Now the fourth thing is that we are also very honest about what's happening. We have been very transparent on how we sort of see what's going on in the strategy, and I think some of our investors will tell you that we take time to convey our conviction to the investors. For example, when we know July end was not looking good, I called a lot of investors. Some of them were like, why are you calling me so much? But if somebody was worried, you have to tell them that, sir, this is why we are holding this. And very interestingly, in a week we saw a rebound happen. So all in all, see, I think this is a great market for active investing. The convictions are getting stronger. The market as an average might not work, but selectively, I think there is a lot of opportunity, and that's where Right Factor Fund is very well suited. And I think it's a good time to allocate and even top up if you are thinking about in a strategy like ours. So that is all I had to say. Questions are open, and my team is also available. So do let us know if you have anything to discuss. That, are you here?
Yes.
Okay.
Thank you for the presentation, Sonam. We have few questions coming up on chat, so we'll start with that. Um, Few investors are asking, is it a good time to top up in a strategy like alpha at the moment? You spoke about factor, but what about alpha?
See, alpha has been tricky recently, Siddharth, as we know. The concentration nature tends to have some impact, but yeah, alpha is picking up, right? I think this month, in August itself, it's up around 6.5%, right? In the matter of 5 days. So where alpha works, it works very well. So but see, I think alpha is a great strategy. I would not stop anybody from investing into this, but it has to be the investor has to understand where they're investing, right? See, you can look at the good time. Alpha did 6.5%. Now I will invest, right? But imagine there is a pain where the strategy also declines, right? Which we have seen in the past. So will you be worried if you can, sort of live with some pain? Then only you have to you get to live with the advantages of alpha, right? So I think that is totally dependent on the investor, on their risk appetite. But I think that alpha is going to have a good time, right?
Right, sure. We also spoke about the returns in the month of July and the returns in the month of August, right? So few
Hmm.
investors are asking, what if we didn't recover in the month of first week of August? Then what would be the exit plan? Do we have like a stop loss mechanism? How does it work?
No, I think that's a good question. I'll just try to dig deeper, a little bit deeper for you, right? When we talk about July, right? And see, I think if these were bad stocks, we would have exited, right? So let's look at MTR Tech as an example here, right? The stock declined a lot. We did not exit, and then the stock recovered, right? It's a very simple story. Now the stock could have also gone down, right? That's what you're trying to say. But see, why we held on to this stock is because of the model. And model said that it's being rated high on the features that you want to invest into, right? And in fact, when I look at the data, right, my conviction was getting stronger and stronger. My ratings were increasing, right? Instead of decreasing, we were seeing the ratings and numbers increase, right? So given that, that what led us to sort of hold on to this stock, right? But so that there have been various instances where we have also exited a particular stock, right? It's not like we don't exit. So for example, um, I mean, there are a number of instances where we would have exited. For example, even in this rally, there is black box, right?
Mhm.
Black box, we ended up exiting the stock, and very interestingly, this one hasn't recovered also. If I go down, um, you will see what was the trigger to sort of exit. We are seeing some derating happen here. So that is where, so we selectively would exit a particular stock, right? But otherwise, if the model is telling us, we hold on, right? And see, had it been an instance that like something that drastic is happening, that everything is going down fundamentally for the stock, we'll exit it, right? But the real thing is that you have to show conviction. So what we hoped was that, okay, soon, maybe April, maybe August, maybe September, we'll see a recovery, right? That's what we believed, correct? That you've seen a decline, but our model is saying that stock is rated high, so we should see a recovery. And if you have already seen, see, I think MTR at 8,000 was a good buy, I would say. It was a strong stock fundamentally, right? It was highly valued. So at 5,500, obviously it's a much better buy, right? It's corrected so much valuation wise, you should be topping up, right?
Right.
And the fundamentals are strong. So that's where we did not exit. And I think we were hoping ki, soon it will recover. It happened in a matter of a week that our losses were recovered. So see, I think if there is a fundamental decline, then we will go ahead and sell the stock. We'll not wait for it to recover. But in this case, that was not what we thought, right?
Right. A few investors are also asking that, is our strategy multi-asset in nature? Are we only looking at equity? Say, for example, there's a much larger drawdown from here. Will we also look at other classes, other asset classes to gain alpha specifically?
Yes, we do. We look at gold, we look at silver, we look at bonds. So we do allocate to other asset classes in the strategy itself. You're seeing some recovery happen in gold. I think China seems to be buying a lot of gold, right? So
Yep,
it seems to
got
be
it.
interesting.
Um,
Yeah.
can you talk a little bit about the risk reward ratio? How do we sort of decide that in a particular stock?
Risk reward ratio.
Like, what is the highest point that we would exit at um,
Hmm.
for the risk that we'll be taking in that particular stock?
So that neither do we have like a limit on valuations, right? It's not like we ever say कि 20 valuation के ऊपर नहीं invest करेंगे. और secondly, we don't even say कि if the stock has grown 100%, then I'm going to exit, right? We don't do that. See, I think you have to be careful with stocks that have grown up so much, right? Obviously, you have to be careful, right? But And that's where we actually trimmed down our MTR exposure in the beginning of July itself, right? So before the decline, we had 10% allocation, we went to 5%. We trimmed down our allocation, but see, I think so we tend to follow the signals as they come. When the signal says that it's a strong time to invest, we'll keep on investing, even if the stock is highly valued or it has reached some sort of a high level. Until unless there's a strong signal to exist, we will not sort of go ahead and do that, right?
Right. Got it. Um,
But yes,
can
that
you
also like, also while filtering the stock, we do have criteria which says
right,
that any stock which has very skewed returns, or any stock that has grown very much in the last 3 months or 1 month, we tend to avoid addition of those stocks, right? But if we are holding, right, we tend to hold on while the signal tells us. Yeah.
right? Can you also talk a little bit about the AI bubble that the whole internet and everybody is speaking about? Some thoughts on that?
No, I think, see, AI is here to stay, right? AI is here to stay, data centers are here to stay. I think, we all in our day to day life, I'm not, even you, I know, and me, everybody sort of uses so much AI in our day to day work, right?
Yeah,
And I think that technology is not going anywhere, right? I think the technology is here to stay. I think data center infrastructure in India will continue to grow. I think that will lead to power sector growth. That will lead to Indians exporting a few things in the power sector to the global market. That whole cycle will keep on happening, but there are pockets where there's overvaluation. For example, memory chips, right? When you look at memory chips in the US, right? In terms of fundamentals, stocks are coming up with exceptional earnings and massive order books. But the level of frenzy that has happened in terms of prices got cooled down, and then margin, the leverage got hit, and that led to some correction which was sharp. So see, I think like the internet bubble, right? There can be bubbles in terms of prices at various times, right? That people tend to go crazy in how they are buying. Demand goes very high, but then the prices could cool off. But the technology is here to stay. And what I would say is India is a little bit immune to that global bubble, but in India there are various ancillary space. So right now, should we invest into a stock that has gone up 200%? We have to be careful. But there are other instances within the market, right? Somebody who is, let's say, creating cooling equipment for data center, somebody who is creating other ancillary products for the data center, right? Those opportunities are still going strong, and you'll see growth there. So I think that's how we are approaching it. I think but even on the global levels, if you look at hyperscalers like Google or Meta, right, you would see that even those stocks haven't had like a uh, very good year, right? So let's look at like in the recent times. For example, somebody like Google has also seen decent amount of correction, right? um, and we've seen what's happening in SpaceX, we've seen what's happening in Tesla. Right? So it's not like that these stocks are at an extreme peak. But yes, I think there will be some price based bubble that would happen here and there, but I think the technology definitely is here to stay. All right. So you're there? So I think we got disconnected, Siddharth, right?
Now, am I audible?
Yeah, I can hear you.
Right. So on the small case side, few investors are also asking if the HNI small case right now is a good opportunity to invest to get a flavor of the PMS itself.
100%. 100%. Yes.
Right. Perfect. I think we've answered most of the questions. For any questions that would have been left, would request you to sort of email it to us, and the team will take it from there. Closing notes from your side, Sonam.
No, I think first of all, thank you everybody for joining, whoever joined, and I would just say that it's been a very eventful few days for us. And I think the market has awarded the conviction. I think the conviction is going to stay, and this is a strong time for our strategy and how we, the lesson that we have learned. I think it's a good time to invest into strategy like ours, and I think it's a good time for the market, not for a passive index, but for stock selection. So, you so stay invested, allocate to those type of strategies. And if you have any questions, do let us know. I think me and my team will be very happy to talk to you and answer any of your questions.
Okay. Thank you for your time, Sonam.